Okay, hi everyone. This is going to be the first of 3 lectures for Chapter 18. We're going to be looking here at corporate taxation and non-liquidating distributions. So if you remember from the previous chapters where we discussed, if we're looking at the timeline here of what's going on, we first discussed forming a corporation, ending a corporation, what are the tax consequences of that. Then we looked at the 1120 at like a high level overview of what's on it, book to tax adjustments, some different terms and techniques that are used. Now we're looking at another area, kind of when the corporation is operating, it would be distribution. So that is to say, there's property distributed to the shareholders that are non-liquidating. In other words, this isn't when the business is going out of business. This could just be in the course of its ongoing operations. It makes a distribution that is non-liquidating. So we're going to do about 13, 14 slides here. We'll break up the chapter into 3 different areas here. So as I have here, a corporation can distribute after-tax profits to the shareholder. It can be 3 different things, and we're going to look at the 3 different ones throughout this chapter. So basically, hey, we have a corporation, we make money, we pay tax on that money. Whatever we have left, if we want to push out to a shareholder, that can be classified as one of 3 things: a dividend, a stock redemption, or a partial liquidation. Now, however we characterize this, when we're having the distribution to the shareholder, it's important because there's different tax consequences for each of the parties involved, the corporation and the shareholder. So, as I have here, if it's characterized as a dividend, then the corporation's not going to get any deduction for that distribution, and the shareholder obviously is going to have to pay tax on that dividend. So that's why we kind of have that second layer of taxation that we discussed about with corporations. Now, in this situation, right, to avoid this lack of deduction, if we call it a dividend, us as the corporation does not get a deduction. There have been instances and situations where a corporation may try to sneakily call this property distribution, recategorize it to something like a salary, bonus, interest, or rent. So, hey, you're an owner, we're going to just call you an employee, or you're working for us. This would be your pay. However, in these situations, right, the corporation here is trying to take a compensation expense. They get a deduction, and the employee, the quote unquote employee shareholder, assuming it was just a fiction, would have income. In these situations, the IRS is going to basically do a look through, substance over form doctrine. What is really going on here? Is this just, you trying to cover up a dividend so you, the corporation, can receive a deduction? Or is this just really a dividend that we're looking at here? Now, in any event, subchapter C provides for the rules of the taxation of dividends. And basically with them, anytime you're a shareholder and you receive a dividend, you're either going to have a preferential tax rate on those dividends, assuming you meet certain rules, or part of what you received would be a non-taxable return of capital. So a lot of this chapter, it's a little bit ambiguous. You have to think about it. We're having an ongoing functioning corporation that is distributing after-tax earnings. This chapter is about describing and presenting the different scenarios and rules and tax obligations for when that happens. And it's not as simple as just everything is this. There's certain situations and areas you have to be aware about. So, as I have here, as an overview, right, when a corporation distributes property or cash to its shareholder, this is going to be a dividend and or a return of capital. If it's a dividend, right, obviously we said the shareholder has to include it in income. If it's a return of capital, then the shareholder is going to reduce their tax basis in the investment. Once you eat away at the entire basis, anything in excess of that is going to be treated as a taxable capital gain. So let's just say, for example, you own Apple stock. You have $1,000 that you own of it, right? Apple decides to push out as a distribution to you $300. And based off the tax rules, let's just say that this is considered a return of capital to you. Well, basically, in this case, all you're going to do is reduce your basis in the Apple stock by $300. So now you're going to have $700 as your basis in Apple stock, and that $300 is just a non-taxable return of capital. Now, if instead, right, let's say they pushed out $1,200 to you as a return of capital, well, it would eat away at your entire $1,000 basis, and then that remaining $2,000 that you received would be a capital gain. So that's kind of what they're saying there. So how do we know, right, whether it's a dividend or it is a return of capital? Now we're going to kind of start to get into the rules for how we would look and describe these things. So the IRS code says this: a dividend, if we were to just look at an ambiguous property transaction with a corporation where they were to distribute property, this would be called a dividend when there would be a distribution of property to cash when it comes out of earnings and profits. In other words, and we're going to be talking about this a lot, E&P, that's what it's called, earnings and profits, which is basically a way of measuring a corporation's ability to pay dividends. E&P, what it basically is like a proxy for economic earnings. It's kind of like book retained earnings. So if you remember in your financial accounting class, right, when you have retained earnings, it's your beginning retained earnings plus your net income minus your dividends equals your ending retained earnings. There's a similar setup with E&P. You basically have like a roll forward you have to do every year where there's a current E&P, which is kind of like your current year net income. And then there's an accumulated E&P, which is kind of like your retained earnings, right? Retained earnings would be like your accumulated net income. Now, one thing to be aware of here, because we said E&P helps us determine whether a distribution is considered a dividend, and we said E&P is kind of a proxy for book income, it's economic earnings. Right off the bat, then, we have to be aware that taxable income does not equal E&P. So one of the kind of interesting things here is if you want to calculate E&P for purposes of determining whether there was a dividend made, the entire event basically starts like this, right? You have your book income, you have to make your book to tax adjustments to arrive to your taxable income, and then you have to make a separate set of adjustments to go from your taxable income to your E&P. So you can see this kind of like 2 or 3 layers there. So as I've indicated here, right, why we care about E&P, it determines whether we had a dividend that was paid. There's 2 types of E&P. We have current and accumulated. It's kind of like net income and retained earnings, current year and then all the other years built up. So current E&P, and this is what I was discussing kind of high level, how we calculate it is we take taxable income and we make adjustments to it. If it's positive, right, if current E&P is positive, then the distributions are considered dividends. Anything left over is then going to be added to accumulated earnings and profits at the beginning of the next tax year. As I have here, right, a corporation can only make distributions to the extent of E&P. In other words, you can't have a negative E&P from a distribution. And finally here, a distribution that is greater than E&P is considered a return of capital to the shareholder. So let's look at 18.1 here. Okay, so we have 2 shareholders here, shareholder 1 and shareholder 2. We're just going to focus on shareholder 1. They own 75% of the corporation and they have a tax basis of $24,000. looks like the corporation has current E&P of $30,000 and no accumulated E&P. So what this means is the corporation had taxable income, they made adjustments to it to arrive to their current E&P, and that amount was $30,000. Then what it says is the corporation makes a $64,000 distribution, of which $48,000 went to shareholder one. So what is the tax treatment here to shareholder one? Okay, so we said we're talking about E&P. We know E&P helps determine whether a distribution is considered a dividend or not, or whether it's considered a return of capital. Remember, we said any distribution, it can be a variety of things, but one of the big hallmarks we're looking at is what's a dividend, what's a return of capital. If we eat away at our entire basis, any remaining distribution we receive is considered a capital gain. So in this case, right, the first thing they're going to do is take the 30,000 CE&P over the 64,000 distribution. It's going to give us 46.88%. We multiply that amount times the distribution. So what that means is, remember we said if it comes out of CE&P, it's a dividend. So in this case, 46% of the distribution to shareholder one, 48,000, is going to be considered a dividend. That's great. However, the shareholder received a $48,000 dividend. We said 22 of it is a dividend. I'm sorry, the shareholder received 48,000. We said 22.5 is a dividend. What do we do with this remaining 25,000, right? 25.5. Well, essentially what that does is the first 24 of it is going to be a return of capital, right? We eat away at our basis, and the remaining 1,500 is going to be a capital gain. So in short here, right, we're talking about shareholder one when there was CEP of 30,000 and the shareholder received $48,000 of a distribution. Of the $48,000, 22.5 is considered a dividend, 24 is a return of capital, and 1,500 is considered a capital gain. So you can see here, right, that this is like more complicated than maybe just thinking, hey, we received money from the corporation, all of it's a dividend. Someone might say to you, without all of these specific facts, hey, I received $48,000 from my company. Is that taxable? And you would say, well, maybe it's a dividend and you would pay preferential rates. One of the things here, we would need to know in order to fully answer that question, we'd have to know what is the current E&P, how much was the distribution, and then we could allocate it accordingly. So this is just showing us here, right, going from taxable income, we make adjustments to arrive at current earnings and profits. And then assuming you have positive current earnings and profits, remember we said dividends come out of those, any excess you have left in the current earnings and profits is going to be added to the accumulated earnings and profits to give you your ending balance. This is kind of like if you were thinking of the retained earnings, right? If you had net income minus dividends, any excess would be added to beginning retained earnings to give us year-end retained earnings. This is just showing kind of the flow of it here if we were to categorize current earnings and profits and accumulated earnings and profits. So this says year one is the first year of operations. That's why we're going to have 0 accumulated earnings and profits at the beginning of the year. We have, after adjusting our taxable income, current earnings and profits of $30,000. So we went from our taxable income, made some adjustments, and we said our current earnings and profits is $30,000. What that means is at the beginning of next year, our accumulated earnings and profits are going to be $30,000. That's great. Now in year 2, we have current earnings and profits of $5,000. However, we made $2,000 of dividends that we paid from them. So we made 5, but we paid 2. The remaining 3 we're going to carry down and increase our accumulated earnings and profits. So you can see here, this is just showing you the flow and the connection between current, carry it over, current with dividends, carry any excess over. So we talked about a high level, what is earnings and profits? We said we care about it because it helps us determine whether a distribution is considered a dividend or not. We also said that in order, like from a flow level, you have to calculate your current earnings and profits. So you have to go from taxable income to current earnings and profits. Because remember, we said E&P is like economic income. It's kind of like book income. It's not enough where you can just go use your book numbers. They want to make it more complicated than that. But the idea here is go from book to tax to E&P. So some of the book, like those book to tax adjustments, we may reverse depending on the situation. But in general, so first off, there's like a variety of different ways that you could, adjustments you need to make. But basically there's like 4 ways you can categorize them, right? So there could be things that were not taxable on the tax return that should be included in E&P. So in these situations, we would have an adjustment there to arrive at CE&P. Second, there could be things that were deductible on the tax return for which we do not get a deduction in calculating E&P. Third, there could be things that were non-deductible on the tax return that are deductible for purposes of E&P. And then fourth, in light of certain IRS timing rules and other accounting rules, there could be some modifications that we need to make regarding E&P. So the first one here, non-taxable income included in E&P. So this means income that we had that was not taxable on the tax return, but is taxable for E&P. So what that means is we need to add this back to taxable income. We have to increase our taxable income to arrive at our E&P in these situations. So muni bond income and then tax-exempt life insurance proceeds. These were excluded on your tax return, but they need to be included in your E&P. So let's look at 18.2 here. We have taxable income of $100,000. This includes $5,000 of tax-exempt income. How would we arrive at CE&P? Okay, this is pretty simple. We have $100,000, of which in that amount we excluded $5,000 of muni bond income. To get to CE&P, we have to add it back, $105,000. The second one here, these are deductible expenses disallowed from earnings and profits. So these were deductions, subtractions we took on the tax return that we're not allowed to take for E&P. So what this means is we have to add it back to taxable income. In other words, increase our taxable income to arrive at current earnings and profits. So usually these situations, these are deductions that require no cash outlay by the corporation or a carryover from another tax year that do not represent economic income. So things like the dividends received deduction, net capital loss carryover from a different tax year, NOL from a different tax year, charitable contribution carryovers. If you think about it, right, like DRD, when we've talked about this in past, this is basically just a pure fiction created for tax returns to help avoid triple taxation. There was not really an economic outlay here. If we were really looking at book income, like a form of it of our economic income, you didn't really do anything to get that deduction. It's just made up for your tax return. The same with like carryovers as well. Those didn't really happen. They weren't really, happen in the current year. They just happened to be carried over from it. So the idea again with E&P is we're trying to get to our economic income. What is really going on here? So we said certain income that you excluded on your tax return, that was income you made, right? So muni bond income, that's important. That's a type of income. We want to include that if we're looking at our economic income. Likewise, if you subtracted certain things, you got deductions and they weren't really economic related, economic events, they're just tax fictions or carryovers. We don't want those as part of our current earnings and profits income. 3 here. These are non-deductible expenses to reduce E&P. Okay, so these were expenses on the tax return we didn't get a deduction for. However, for E&P, we should get a deduction for these. Accordingly, what we would do here is we would subtract these from our taxable income. We didn't get the deduction before. We should get it now. How you effectuate a deduction is through a subtraction. So certain things here, right, like federal income taxes paid or accrued, tax-exempt interest expenses, charity beyond the limitations, things like disallowed meals and entertainment, non-deductibles, fees, fines, penalties, lobbying, contributions. So, for example, right, on our taxable income, you do not get a deduction for taxes paid. We discussed that, right? However, from an economic standpoint, if we were just looking at, right, what was your income as a business, that would be like a reasonable thing we would expect to see on there, right? I mean, if you ever look at a book income statement, for example, they always have a provision for taxes, right? Things like fees, fines, penalties, maybe they're not the most sought after things we want, right? I mean, nobody is like morally, saying, hey, go get fees and fines, but they are expenses that businesses incur. So for purposes of economic income, it would be important that we were able to get those deductions. For taxes, however, right, for political purposes and public policy, we would not allow those. But that's, for taxable income, not for economic income. So that's the idea with the third category here. You didn't get the deduction on your tax return, but you should get it for E&P. Therefore, we have to subtract from taxable income. The fourth item here. So these are kind of specific add backs or subtractions in light of different accounting methods. So as I have here, corporations must use the same accounting method for both E&P and taxable income. However, some methods can differ between the two, and this can cause either an add back or a subtraction from taxable income, depending on the difference. So some of the examples here, types of income deferred in the current year would have to be included in current E&P when the transaction occurs. So for example, the installment method, this is a type of deferral provision where you would only recognize income in later years. That might, for purposes of E&P, not be allowed. You have to include it in the current year. You have to include the full gain in the current year of sale. Also, certain expenses deducted in the current year taxable income are deferred in determining CE&P. So for example, right, here's one thing that is different between E&P and the tax return, right? So basically on the tax return, you can use things like makers, bonus, 179 as cost recovery mechanisms to depreciate your assets. However, for purposes of E&P, you have to use the alternative depreciation system, and for amortization, 5 years. So the idea here is there's different ways you have to depreciate it for E&P than how you were to depreciate it under your tax return. And this can cause differences between the two. So this right here, and we can kind of look at it, right? It's kind of the 4 categories. You would have your taxable income, then you would do your add backs for exclusions from taxable income. You can see some of them there. You would do your add backs for deductions allowed for tax, but not for E&P. Then you would have your subtractions for deductions allowed for E&P, but not for tax. And then you would have either your additions or your subtractions for those different rules, right? The installment method, depreciation, 179, that's going to affect the basis, which is going to affect the gain or loss on the sale of the depreciable assets, long-term contracts, depletion. Let's look here at 18.3, right? So we have a corporation. They reported taxable income of $10,000 and they paid federal income tax of $2,100. Within this amount, right, they had certain items here that we're going to care about, right? They're telling us they reported the following items of income expense. So they have $50,000 of depreciation, $700 of a dividend received deduction, $3,000 of a prior year NOL carryover, $5,000 of tax exempt interest, $6,000 of interest expense, and $4,000 of net capital loss carryover. So they're asking us here, what is current earnings and profits? And again, why do we care about this? Earnings and profits, current earnings and profits, tells us what is a dividend versus what is a return of capital when we're examining distributions from a corporation. So we know when they ask for current earnings and profits, we have to go from taxable income, make adjustments to arrive at it. So in this case, right, in light of, we're zoomed in pretty well there, these four situations we discussed, right, the types of adjustments you're going to make, we're going to add back that tax exempt interest. Right, we didn't include it on our tax return, but that is a type of economic income, right, that we care about. Likewise, we took a deduction for the dividends received deduction on our tax return, but that's really not an economic deduction, right? That's just a tax fiction. We have to reverse that out, add it in. Same with an NOL carryover from a prior year. That's not really something that was economic in the current year, so we shouldn't be allowed to utilize it, add it back if we previously subtracted it. Likewise, we know in this case that on our depreciation, right, we have some excess depreciation. Again, I'm not going to ask you to calculate the amount of depreciation. That's like a tax one idea. But the idea here that if tax depreciation exceeds the amount of depreciation for E&P, namely the alternative depreciation system, then we're going to have an add back here. In other words, we did too much deduction on our tax return, and this is reasonable, right? If you have 179 in bonus, that's going to get everything off the plate to begin with. And if you're using ADS, you may not get that big of a bite for depreciation under it. So you depreciated too much on the tax return, too much of a deduction. We have to reverse that out. Likewise, federal income taxes, we said on the tax return, you don't get a deduction, but for E&P, that would be an economic event that we care about. Same here with the non-deductible M&E. In this case, for taxes, maybe they only give you 50% of it. And then you also would subtract out the net capital loss carryover for the current year. So that's going to get you here to your $26,600 current earnings and profits. Now, example 2 here, this is basically the same as example 1, except let's assume that there was a $1,000 deferred gain from a like-kind exchange, and $75,000 was deferred from the gain from the installment sale. Well, basically what we're going here is on our tax return, we recognize 25 and deferred 75. Under E&P rules, they say no, this transaction, we're going to say all of it we recognize in the current year. It's like you made the sale this year. So that's 75 you don't get to defer. We have to increase our taxable income for it. So with that, right, we looked at a high-level overview here. In this case, we're going to pause the lecture. I think that's a good stopping point. We're about a third of the way through. So just, again, think about what we're talking about. E&P helps us determine whether a distribution is a dividend. To reach E&P, we have to go from taxable income to E&P. There's certain adjustments we need to make, certain addbacks or subtractions. Why we're doing it is we're trying to get to economic income. Overall, the big picture story, you go from book to tax to E&P. So with that, we'll stop the lecture here.